Namaste to all. I welcome you on this very important stakeholders outreach today. I, along with my Vice Chair Abhay Chajerji and all the team of the ASB, welcome you all. Specifically, our panelists today, none other than our own very lovable past president, T. Amarjit Chopra ji, who has been not only the chair of the NACAS earlier, now a member of the NAFRA. But yes, the way he has a command over the accounting and auditing aspects, and the way he always educates the members and industry is really remarkable. Sir, I welcome you and thanks for joining and sharing your views for this outreach program. Also, we have CA MP Vijay, fondly we call him MPV, who is very well known for his acumen on the accounting standards in days, I would say. And he is the past chairperson of the accounting standard board of our institute. I welcome MPV sir also, and thanks to him for joining this panel discussion to share his views. Also, we have got CA Smriti Goyalji, who is from the industry. In fact, she's the controller finance of the Tata Group, the Tata Motors, and who's got a good knack on the financial aspects, including the Ind AS. And to moderate these three stalwarts, we have none other than Archana Bhutani ji, C. Archana Bhutani ji, who is currently partner of Deloitte and always a regular contributor to the institute. And she has been faculty for various of our webinars in the Accounting Standard Board and ESC. And of course, she will be, though she is a speaker also, but she would be moderating this stalwarts, which is another good task. Managing these three stalwarts, we wanted another stalwart. Welcome, Archana ji. Welcome, Archana ji. And in fact, we talk about today this outreach program, which is about the amendment in the Ind AS. And including that, one of the most important is the exposure draft which the ACI has issued, ASB has issued for removal of the carve-out, which is there since the last 6 years. What was the need? What are the issues? What are the amendments? That our moderator Archana will be taking over. But before just that, I'll request my vice chair if you have very initial few comments to make, so that we can take the technical content thereafter. Just.
Thank you very much, Chairman CA Pramod Jain ji. Of course, I would say it's almost on the verge of completion. Our 1 year period, you as a chairman and I being as the vice chairman of the Accounting Standard Board, it was truly an honor and privilege for me to work under your guidance. And I think excellent agendas we had taken up throughout the year, which we got it implemented with, of course, tremendous support of all the council colleagues and co-opted members, special invitees. And again, I would say truly an honor that we have an outreach program where I could see one of my mentors, Amarjit Chopra ji, past president. It's always been an honor, to share dais with him in past, which I have done in various bank audit seminar. And of course, it's always a pleasure to listen to him. And he's been sharing his views on Ind AS, the accounting standards, the standards on auditing, the bank audit experience which he carries, and of course personal comments which always helps me to or encourage me to keep improving each day whenever I get an opportunity. Thank you so much for being here today. And again, we have MPV sir, like you mentioned, MP Vijay Kumar, the past council member, truly a person who has been contributing a lot. And I have my experience of last 1 year. I've seen so much we have interacted with, I would say, opinions being shared, but it's always a pleasure, to listen to him and to reach to a conclusion on various aspects, issues, which we have discussed during our ASB meeting or even during our study group meetings and other issues which we have taken up during various meetings throughout the year. So thank you, MPV sir, again for the entire year. And of course, Smriti Goyal, she's here again, one of the panelists which we have from Tata Motors. Thank you on behalf of ASB. And of course, for Archana, I can say only that, it's just on a call away. Wherever we want her to be there for any meetings, any study group, she's always available and contribute a lot and has done tremendous work with us throughout the year. So she'll be moderating the entire this program to us outreach program, and from the office, Gupta ji, Parminder, and others who are here. So I once again welcome on behalf of ASB as Vice Chairman, and I'm sure a lot of issues which we have received for this outreach, the proposed amendment in the Ind AS 1, where we have to discuss on the carve-outs, the issues which are there in terms of classification of the liabilities as current or non-current. I'm sure we'll have a good interaction, and everybody attending here would really be benefited listening to the stalwarts of the Ind AS and AS which we have today as panelists. So thank you and welcome all of you once again. And over to Archana to commence this program. Thank you, Chairman, and thank you, everyone.
Thank you very much, Abhay. In fact, friends, today, though this exposure draft is there already, the last date to comment was 31st January. But now, feeling that we require more response from the stakeholders. Today, we have stakeholders from industry, from bankers, from ISB and everywhere. What we want is that after having this whole discussion, we request you to send your comments to asb.ici.in. The exposure draft is there at the ASB portal, asb.ici.org. So you can have that exposure draft and then send your comments to comments@asb @ici.in or asb@ici.in, any place. It is given in the exposure draft also. So what would happen on the removal of the carve out for the change in the classification due to breach of the covenants? Let us have a discussion along with the short introduction. I'll request Archana ji to keep the introduction a bit short and then have a full-fledged open discussion there on the issue. Over to you, Archana ji.
Thank you so much. I'll request the office to just upload the presentation. I welcome everyone and a very good afternoon, and it's a pleasure and honor to host such an eminent panel. The topic for the outreach today is of significant relevance, and just like the chairman said, it does involve a discussion on whether or not a carve-out needs to be retained. That's part of it, and therefore I'm really looking forward to an insightful deliberation with panelists here. I'm going to first of all just quickly take you through the amendments which are there, just a quick overview of the amendments. If you were to look at, and when I'm going to structure the discussion, we're just going to do it in three parts. When you look at the amendments, there is one part and a larger part, which is dealing with convergence with the amendments which have been made to IAS 1. So that's quite a bit. And then there is a discussion, or there is an amendment as far as the existing carve out on compliance with loan covenants is concerned. So we'll discuss that before we come to the applicability date and the transition provisions. So if you were to look at the Ind AS 1 requirements, the standard requires a company to classify debt as non-current only if the company can avoid settling the debt in the 12 months after the reporting date. Now, quite often the company's ability to do so is subject to compliance with covenants. So you may have, for example, a situation where a company has a long-term debt and it could become repayable within 12 months if the company fails to comply with the covenants in the 12-month period. Now, when you look at the proposed amendments, like I said, the amendments seek to now address how compliance with these covenants may affect the classification of debt as current or non-current at the reporting date. It is expected that the amendments will promote consistency in application and also clarify the requirements in terms of determining whether the liability is current or non-current. So like I said, I'm going to structure it in three parts. So we'll move on to the next slide. Yeah. So the first bit is on the requirement as far as the right to defer is concerned. So if you were to look at the existing requirements say that the companies should classify a liability as current when they do not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting date. Now, as part of the amendments, the reference to this right to being unconditional is being removed, And instead, the amendments will require that the right to defer settlement must have substance and should exist at the end of the reporting period. Now, why is this change being made? There are two reasons. One is that quite often the right to defer settlement is rarely, if you look at it, it's rarely unconditional. They will quite often be, the right will be conditional on compliance with covenants. And secondly, if you were to look at the standard, while para 69, which is there on the slide, referred to unconditional right, if you go further and there is a paragraph 73 which talks about refinancing of loan, that refers to an entity's expectation. So there was a kind of an apparent, in a way, contradiction between the two requirements, and therefore the reference to unconditional right is being proposed to be deleted, and the right will have to have substance and it should exist on the reporting date. Now, there is limited guidance on how to determine whether this right will have substance. It would require some exercise of judgment by the management. In terms of what constitutes settlement, or in terms of when does a right exist, there is the amendments also bring in the relevant guidance. We can move on to the next one. Yeah. So if you look at now in terms of clarifying whether or not a right exists as at the reporting date, specifically 2 paragraphs have been added. The amendments will clarify that the classification of liability as current or non-current should be based on rights that exist at the end of the reporting period. So like I said earlier, the right may be subject to compliance with conditions in a loan agreement. So let's look at what happens if the covenant or the condition has to be met on or before the end of the reporting period. So if the company is required to comply with the covenant on or before the end of the reporting period, such a covenant has to be considered, and it will affect whether the right to defer exists at the reporting date. And like I said, it will affect the classification of liability as current or non-current. This will be the case even if the assessment of compliance with the covenant is done after the reporting period. So just to take an example, let's say you have a covenant which is based on the company's financial position at the end of the reporting period, but it is assessed, let's say 6 months down. So say you have a requirement, loan agreement requires a current ratio of 1 to be maintained as at 31st of March 2023, but the bank will assess this compliance only say in May or June. So even then, as long as the condition has to be complied with as at the reporting date, it will be relevant for assessment of classification. Now, you may have a covenant which the company is supposed to comply with, but that compliance is after the reporting date. So such a covenant will not affect the right, it will not affect the classification. So it will not impact. So for example, let's say the current ratio, company has a current ratio of 0.9 on 31st of March 2023, and the loan agreement gives time to the company till September 2023 to reach a current ratio of 1. So because this compliance there is still time for this compliance to be met, and that is after the reporting period, this will not impact the classification. Now, one may, when you look at it, it may seem very intuitive to say, of course, if it is after March, why should it affect the classification? The reason this went through a lot of deliberation is because think about it, that if you're a user, today you're looking at a liability as non-current, but let's say it is expected that the management may not be able to comply with the covenant, say by September or whatever the date is, within the next 12 months. And the money will actually go out within the next 12 months. So on one side, at the reporting date, there is no obligation to repay, but depending upon the compliance within the next 12 months, that money may become repayable. And that is where there was a lot of discussion in terms of whether or not a future covenant should impact the classification. So while the amendments have clarified that you will only look at the covenants to be complied with at the reporting date and not the future covenants, to make sure that the users get the relevant information in terms of assessing the risk that the company may be exposed to, certain disclosures have been are also being included. So the amended classification requirements will actually provide useful information when you look at the classification together with the disclosures. And In terms of the classification, the amendments will now include a paragraph which will explicitly clarify that the classification is unaffected by the management intention or expectation regarding the exercise of the right or settlement of the liability within 12 months after the reporting date. So let's say you're looking at March 23, the financial statements are being signed off by September, and you know the company's repaid the loan, early repaid in June. Even then, it does not impact the classification. Or let's say the company has a right to defer, but it does not intend to exercise that right to defer. So the intention would not really be relevant in this context. Yeah. So if we can just take quickly an example to understand this. You've got a situation where, let's say, the loan is repayable in 2026-27. It requires a covenant which requires a current ratio of 1 as of 31st March 23 and 1.4 by 31st of March 2024. When you look at the company's situation as of 31st March, its current ratio is 1.2. But when you look at the expectation where the company expects to reach by March 24, it expects to have a current ratio of 1.3. Now, the question, if you were to look at the three and see whether they will impact the classification or not. The first is you've got the requirement, the loan covenant, that the current ratio should be 1 on 31st of March. That, of course, needs to be taken into account because it's a covenant which has to be met by the time of the reporting date. So yes, this will impact classification. And in the given example, because this condition is met, the loan will take the response more towards the non-current classification. If I look at the future covenant, which is 1.4 by 31st of March 2024, this will not impact the classification because this is a future covenant to be met later. It does not impact the classification at the reporting date. But like I said earlier, because the company is exposed to the risk that this may land up being repayable earlier if this covenant is not met, disclosures will nevertheless be required. Now, you've got the expected situation. So let's say you're signing off the financials in September 2023, and you know that by that time the company expects that I will not meet the covenant as at 31st March 24. Again, it's a future requirement. It will not impact. So management's expectation in terms of being able to meet, etc., will not impact the classification. So hopefully this will clarify how the classification guidance would apply when you look at the loan covenants. We can move on to the next slide. I did mention that when it comes to future covenants, while it will not impact the classification because there is a risk that the amount may become repayable, the standard nevertheless is proposing certain disclosures. So as you can see on the slide, it requires information about the covenants, the nature of covenants, when the company is required to comply with them, what is the carrying amount of related liability. And the next one is very interesting. It says facts and circumstances that indicate the company may have difficulty in complying with the covenants. So in this case, if you're mentioning, let's say when the disclosures are being made, a company can mention the mitigating actions it has taken after the reporting period. Or let's say the company may even add actually as at the reporting date, they're not meeting this condition. So this will become very relevant in terms of kind of bringing out to the reader the risk that the company is exposed to. Let's go to the next one. Yeah. The last bit in terms of the convergence amendments is in terms of settlement. As per the proposed amendments, it is important to link the settlement of the liability with the outflow of resources. So as you can see, it requires that settlement happens when there is a cash outgo or outgo of other economic resources or even through entities' own instruments. Now, one of the requirements of the current standard, which remains unchanged, is that a rollover of a borrowing will be considered as an extension, because when you're rolling over, there is no transfer of economic resource, and that would not represent a settlement. Now, when you look at the settlement by entity's own equity instrument, I think that's an important one here. A settlement by entity's own equity instrument will be considered as settlement for the purpose of classification, but there is one exception. So let's say if there is a conversion option, which itself is classified as an equity instrument, that would be disregarded when determining whether the liability is current or non-current. So this can be a significant change for entities which until now have only considered the date at which the cash payment is required to be made. So if a conversion option is classified as a liability, then the transfer of equity instrument would constitute a settlement of the liability. Let's go further. Yeah. This is the next one, which is relating to the carve out. So currently, the standard has a carve out compared to the international standard. Effectively, if there is a breach of a material covenant and that breach is in a way condoned before the financial statements are approved, the liability is classified as non-current. This carve out is now proposed to be removed, which means that if there is a breach of a loan covenant as at the reporting date, irrespective of the post-balance sheet event, it would be non-existing and the classification would not take the condonation into account. Can we go to the next slide? And while reaching this, I think when you look at the considerations that the ASB applied, one is that it is conceptually not aligned with the corresponding international standard. Secondly, the objective was to sooner or later reach convergence, and because it's been already 6 years since India's implementation, it was considered that it's good time to kind of redeliberate whether the carve-out needs to be continued or removed. So that's in terms of the carve-out. Moving further. And the last is in terms of the applicability. The amendments are proposed to be applicable for annual reporting periods beginning on or after 1st of April 2024 with, in accordance with India's 8, which means you will apply this retrospectively. We did speak about the carve-out. The carve-out in India's 1 also necessitated a corresponding carve-out in India's 10. So that will also be a consequential change will be made to remove that as well. So that's in summary the requirements, and maybe now we can move to the deliberation that we have, and therefore I'm going to just start in the same, going through the kind of amendments that we discussed. I'm just going to go in the same order in terms of the discussion, and I think therefore my first question would be that when you look at the existing requirements, the fact that the reference to unconditional right is being removed and it is going to be replaced by the requirement that the settlement must exist at the reporting date and should have substance. Do you see this as fundamentally impacting the basis for classification of a liability? So I'm going to maybe start with MPV. How do you see this change? I think you're on mute.
Unmute, sir, please.
So sincere thanks to Chairman Pramod and the team at ASB for the invite and opportunity to be part of the panel along with past President Chopra ji. And thanks Archana for the wonderful introduction of the proposed amendments and setting the context. I'll just take a minute to make a generic observation before I come to the specific query which you asked. As a common point, I would recommend that it's important we keep in mind when we deliberate this amendment exposure draft which is there, the need to appreciate that Ind AS is intended for large public interest entities, essentially listed companies, banks and insurance companies whenever it becomes applicable. Unlike other jurisdictions, in India we have made Ind AS applicable for unlisted companies, and that too as small as $30 million equity. For listed companies, we need to have the best of practices. For the unlisted companies, particularly as small as $30 million equity, these disclosures or classification requirements, in my view, are less relevant. Having said the above, from a standard setter perspective, that is as an institute, and also from the users of financial statements perspective, this is a welcome change. I don't think either the standard setter or a user of financial statement will have a disconnect or will not welcome this change. It will make the classification less judgmental. Of course, there's a judgment on whether the right is substantive. We have, and as you mentioned, Archana, there is limited guidance, but I think the concept of substantive, we have applied it across other standards and even in auditing. So I guess it shouldn't be too difficult. From an industry perspective, I think whether it is unconditional being removed and the word substantive being added, I think industry will be fairly neutral on that. And it will actually help them apply this much better, because most cases the right to differ comes with some condition or the other. Whether that condition is major or minor, it affects. But the moment you bring this substantive kind of a judgment, I think for industry it is a little beneficial kind of a provision. I would put it that way.
And I'll request if Smriti can pitch in here, just to kind of understand, while conceptually this may be, like MPB said, a good change, do you really see this having a significant impact, or you see this largely clarificatory with more details coming in, or do you expect many classifications to actually go through a change because of this?
Thanks, Sarchana, and thanks to the Institute and the chairman for inviting me and being part of the panel where Amarjit sir and MPV is there. Thanks once again. So looking from an industry perspective, it depends, Archana, that how does a company monitor its governance and all other things, right? So if they are monitoring it well in advance and they have been talking to their lenders in terms of if there is a breach which is happening, that means that the right to defer the settlement, where we are saying has a substance or not. So if they are proactive enough, I don't see that this particular change is going to impact. But at the same time, yes, there are companies where in past, the way the present Ind AS 1 was there, if the governance has been breached, but at the same time before approval of financial statements, you are able to get the breach condoned, you were still classifying that as non-current. With this amendment, that particular classification will still remain as current. And the way I will see it is, as IS 1 is more aligned to that, the financial statements, what India is going to prepare it, and will be more in line with what other peers are doing across the world. Obviously, for listed entity, it is more relevant, as an MPV said. Even for unlisted entity, this comes as a change for them.
So if I can just continue with this discussion, Smriti, just one more bit. Like I said, there are arguments both ways to say whether or not you should take into account future covenants. On one side, we say, okay, it is to be met in future. There is no obligation to repay today, so why should I take it into account? But then, like I said, there is a counter side to it, that it could happen that the company may land up repaying this in the next 12 months. But the proposal will still keep those out, subject to disclosures. Do you agree with that approach?
So again here, I will say purely from a financial statements perspective, I agree with that approach. But if we look at from the readers of the financial statements, they will not get the full picture of it, right? They will not understand the risk that the company has in future. There, I would say that we should have discussions in terms of whether such kind of disclosures can come as a risk in the forepart of our annual report of a company, where the company management can clearly give in that, okay, there are various governance that the company is supposed to be getting in, and they have to comply with those covenants. But future, because of certain uncertainties involved, say for example 2 years back, because of COVID, there was so much of uncertainties involved, and I am sure that many of the companies would have struggled for their covenants meeting as well. So that kind of disclosures can come in the forepart of an annual report, so that a user or a reader of a financial statement, or who is somebody who is investing in the company, is able to get the full picture and the risk around it.
Okay. So may I request you to pitch in here as to how do you see this test that we will, when we're looking at whether the right is existing as of the balance sheet date, we will ignore future covenants which have to be met within the next 12 months. I'm not about 24 or 36 months, but even the next 12 months, those need not be taken into account.
Thank you, Archana, and thanks to Pramodji for that matter, for really inviting in this outreach program. I think, of course, whenever one has to share the platform with MPV, one shudders to think of it as to what can be said and what cannot be said. And of course, now we have the industry stalwart also in the form of Smriti Goyal here. See, to me, very frankly, whether you remove the word unconditional or you don't remove the word unconditional, even if you're talking about the word substantive or in substance, whatever way you want to do it. See, even when you talk of unconditional, it has to be proved that it is unconditional. Let's be very clear about it. After all, whether it is for the management or it's for the auditor, one has to really go through whether that right was unconditional or it was conditional. Similarly, when you talk of the substantive part, can the management take a call without really analyzing the facts whether it is substantive or non-substantive? Whether an auditor can take a call without getting into the fact whether it is substantive or non-substantive? To me, that's not going to make the difference. Let's be very clear about it. I'm very clear. After all, the responsibility of the management and the responsibility of the auditors are going to remain the same, whether you keep the words unconditional or you keep the words substantive. So far as to me, what worries more is, and I think there I will definitely like MPV to pitch in. What I'm feeling is that we are already loaded in the financial statements with the kind of disclosures. How many disclosures? Now, even if you have to explain how you have reached whether it is substantive or non-substantive, I think reader is going to be burdened with one more thing. And I am very clear that if you say it is substantive, somewhere or the other, someone will have to say how you feel that it is substantive or some. And even if you are going to rebut that it is not substantive, you will have to rebut that it is non-substantive. If all things are going to be covered by way of the disclosures, it may be good that you come up with the disclosure, you make the financial statements far more meaningful, far more transparent. But at the same time, please try to understand the plight of the reader of the financial statement. And the kind of audit committees that we have, and I can tell even to Vijay, even in the listed entities, some of the bigger listed entities, whether the audit committee chairman himself understand what is substantive or non-substantive, whether the chairman of the risk committee understand what is substantive, non-substantive, it is very easy to say sitting over here, substantive, nonsense, substantive, etc. I think to understand those covenants and the substantive part thereof is going to be very important. And I personally feel that whether you talk to Reserve Bank of India or you talk to IB or you talk to the bankers, whether banker will like to dilute their rights with regard to any of the covenants, it's going to be an issue. To that we will come little later. So far as your part of future covenant is concerned, I am very clear on that. Even if it is said that you will be able to clear it or you can clear it by say 30th September, 30th June, 31st of July, the management and the auditor will have to look at it, whether it has actually been done or it has not been done. And if it has not been done, then naturally the entire purpose, you get back to the same position, basically, that you will have to get back to the current liability position rather than being non-current. And I think that position, if you ask me, because we always say that IFRS are more principle based. If I look at principle based, then I think that principle applies today even. But we want to make it far more elaborative. It's absolutely fine with me. I have absolutely no issue so far as that part is concerned. But to me, one thing is very clear. Whatever is to be complied in the next 12 months, one will definitely have to, till the time of the audit or till the time the approve, one will have to look at all those conditions basically. And to me, The more difficult part will be here. I will definitely like both Smriti and MPV to chip in. If you say that current ratio management feels can be improved, how it can be improved? Management will have to give the reasons how they feel that the current ratio will be improved. Whether it will be through the inflow of the cash through some sources or reduction of the current liabilities in a particular form, and whether that would require some kind of disclosures or not, to me that will be very, very important. Because to me today, one of the real challenges is, very frankly, we all lay down with regard to the current ratios, some other ratios, debt equity ratio, particularly when the accounts are restructured even. And those are not being met, very frankly. And those are not being met till the time of the approval of the accounts. But the fact remains that the bankers have never invoked it. For the last 10 years, the same situation has been continuing. So substantive part when we talk of, substance part when we talk of, whether the actions of the bankers or the action of the lenders in the last 5-10 years under the similar situation will form basis of this assessment of the substantive situation or not, to me that's very, very crucial.
So before MPV and Smriti comes in, maybe can I just request it? Maybe first, if you have any comments on whether or not the right has any substance, if you can clear that. I like to, as regards the future covenants, I like to put in a very specific situation before you respond. So maybe on the substance, any comments, MPV, Smriti?
Now, on the substance part, the way I understand Archana is that, and I thought you articulated well when you introduced that slide around para 69. So when it came to unconditional, it was sort of little lacking utility. It was not having utility because it is rare, extremely rare that somebody will have a right to defer unconditionally. There will always be some conditions or the other. The question is whether those conditions have a weight which can impact your right to defer or not. I think that's a very practical change which has been done. So from that perspective, I think removing the word unconditional and bringing the word substantive, is it substantive? I think is a welcome change. And my view, in a sense, it also is in sync with the institute's earlier thinking when we went about the carve-out and all. We wanted to do something which is more reflective of the substance rather than the form. So if you look at when you use the word unconditional, there are many conditions which are all in form, but in substance, only some of the conditions are relevant. It is those conditions you should actually be more concerned about. So I would say that para 69 is a welcome amendment. That's my thought on that.
Smriti, any comments on this?
Yeah, so Archana, the way I also see it's a welcome change, and instead of saying that it's an unconditional right, what we are saying herein is there is a right to differ and it has a substance. So in a way, the standard setters are recognizing that something which has a substance needs to be taken care while doing the classification. So I agree with the change which is happening.
Okay. And I think largely and I do feel it's very difficult to really lay down rules regarding what is substance. I guess, like MPV said, when we look at substance, various other transactions, I think that kind of an approach will just follow through even when we look here. But taking forward the question that Sir raised to the two of you, I like to just put that a bit more in detail, and I think that's very important. See, one is when we come to future covenants, one is we say let the future covenant also impact the classification. This is what IASB did deliberate at a point of time. So let's say I have a future covenant which I have to meet by by 30th of September. If I say take that into account and do a classification, it does give a strange outcome because I may classify something as current even though I don't have an obligation. So when you look at the definition of current liability versus current asset, while current asset talks about expectation, liability is based more on the obligation. So I thought the fact that future covenant is not being taken into account is in a way consistent with how the current liability is defined, wherein you see whether or not there is a obligation. But the counter is that if you are to totally ignore it, and like Sir said, you know the money is going to go out, it is not going to be complied with, shouldn't the user get to know? I thought that the standard balances that by bringing in the disclosure. So we will not be making disclosures to highlight how substance is there. I don't think that is what the standard is saying, but it is more about the covenant and the difficulty. So let's say while I'm compliant today, but I foresee a difficulty in compliance, let's say within the next 12 months. That is where the disclosures would be. Yes, it does add on, like Sir said, burden in terms of disclosure. But how do you see that? Do you think it still be relevant for the users, or just a classification without the disclosures would be adequate?
So the way I see it, these disclosure is going to help the user. As you said, Archana, that today the standard is saying that we have to just look at the reporting date. If reporting date you have met the covenant, you have to still classify as non-current. But going forward, if you are not meeting any covenant, or if the management believe because of certain reasons they may not be able to meet it, there are disclosures which is being asked under the amendment which is there. So this will obviously give a useful information to the readers. They will be able to understand the risk that particular company is carrying in. So I think that this disclosure is going to help. And as I said earlier also, maybe in the fourth part, the management should explain it much better in terms of, as Amarjit sir said, that how they are going to cure it, what is their plan, that how they are going to cure that future problem that is there. So it will really give a useful information to the readers.
MPV, your comments on this?
Yeah, Archana, I think past president, two things. One, what he mentioned here today. Another, my experience of working with him on a different project. Now, given his experience of bank audits and being on the boards of bank, when it comes to credit monitoring, credit appraisal and all, I think there have been numerous cases where there is clear visibility that the covenants are likely to be not met or not likely to be met within the next 12 months. So when that visibility is there to a select few, it's important that the user of financial information should know it. Whether that should lead to a classification change or disclosure is a matter of discussion. I think IASB initially wanted to do a classification requirement, but our institute and several other jurisdictions have represented of IASB. They took the feedback very seriously and they reversed the amendment and brought in the disclosure, which I think is a very welcome one. The second project where Chopraji was involved and I had the opportunity of working with him briefly was on this CARO 2020. If you look at the CARO, while financial statements are always prepared on the basis of going concern, whether you tell it or not, management has a responsibility, auditors have a responsibility. In CARO, there is a specific reiteration. You actually reiterate once again. In fact, many people asked, why do you want it? Because it's already known. Why do you tell again? But the idea was to increase the responsibility and affirm it once again. And I think largely the society has benefited from that clause. So this particular disclosure, say any case, even current Schedule 3 requires you to disclose covenants of all your borrowings. You are going to add one more covenant to say that yes, in the next 12 months, I am required to meet this covenant. There is a probability I may not meet, in which case the organization runs the risk of non-current becoming current. However, we are taking step 1, 2, 3 to reach that. And my experience, Archana, is that in most of the private equity transactions, and today if you look at capital, bulk of the capital is coming through private capital. And in the private capital, what is happening is, while it is equity, it is a structured transaction. And most of these are debt for a long period of time. Even though they would like to call it as equity, they're basically having some repayment obligation structured in some form or the other. And in all those cases, they're very rigid conditions, that you should have raised further equity before this period. You should have done this. There's so many such conditions which are there. And it is important that the user of financial information should know it. And I come back to what I said at the start. We are looking at Ind AS for public interest entities, the listed companies, 8,000 listed companies. Then there are other companies, fine. But for those companies where the exposure is so big in terms of investor exposure, I think this disclosure should be done, even though it might appear to be adding another 2 paragraphs in the annual report. If people believe annual report will go up by 2 paragraphs, I'm willing to knock off 2 paragraphs somewhere else. But this is an important one which will be helpful for users. That's my thoughts on this.
Yeah. So, sir, if you there any final comments on this bit in terms of the disclosure, and if I may add, I think we've spoken about what the IASB deliberations were. The IASB also considered whether instead of a disclosure, maybe a separate, presentation within the financial statements rather than in the notes may be helpful. I think the sense I get from what you and Smithy have said, probably disclosure works rather than a separate presentation in the financial statement, because that was another alternative, right? Okay. Sir, if you're there, it'll be good to have your final comments on this one.
I'm very much there. You see, I said to begin with, I'm not opposing the change from unconditional to substantive. Let's be very clear about it. But we'll have to educate the membership and the industry with regard to what is substantive. That's the point I'm trying to make out. One question that I raised to both Smriti as well as MPV was, the same bank, the same lender has been with me for last 10 years. Same covenants. And nothing has changed. Current ratio remains the same. The failure to file the stock statements remain the same. The failure to file the financial statements remain the same. But this banker has never invoked any of the recalling notices. What do I look at? Management will tell me, why should I? Why should I classify it as current? The bank has never taken a call to this. Whereas the auditor and the standard would say that you have to classify it as, because substantively there's nothing on record otherwise, except for that the lender has not taken action. Can I take that? And that is my precise problem basically, because every professional in India is going to face it. I can tell you, whether it is the listed company or unlisted company, because some of the defaults continue and the lenders never take a call. Whether I can take the action or inaction of the bankers or the lenders all these years as a substantive evidence that nothing is going to happen, so it should remain non-current. That's the point that I'm trying to raise.
MPV.
I'm being practical. I'm being practical, very frankly, because you see, the management is going to fight with you. You believe me that when the lender has not acted all these years, when this default has continued, how you can say it is current? That's my only issue, nothing else.
Fully agree, sir. Fully agree. I think it is like governance 1.0 to governance 2.0. So that jump we have to do.
Yeah,
I know. It's a challenge, sir. I agree with you.
it's
I
a
agree with you.
challenge.
Smriti, any comments to what Sir had referred to? Any comments from you?
Before
No,
Smriti
nothing
comes,
per se.
I'll just add one more point actually. As far as financial statements are concerned, there is an increasing ask from stakeholders that the financial statement should give a little bit of a predictive view. So, like for example, in Caro 2020, that
Yeah.
going concern is a beautiful one actually. So you actually reiterate that next 12 months you are there.
Yeah.
It can still fail. It's a different issue. It can still fail.
Actually, you are forgetting that Archana was a part of that group.
Yes. So the point is you are reiterating. Now, that predictive value of information is what people are asking. Historically, what has happened is fine. But tell me, in the next 12 months, is there a risk? Now, this particular risk you are evaluating and disclosing. I think from that sense we need to do. I think it will help us also improve the overall financial discipline in the country. I don't think institute alone can lead it. I think the bankers, all of them have to work together to make it happen. And 3 trillion to 10 trillion will not happen without this kind of a collaborative effort on these.
So we do have one question which has been posted, and I think that just kind of, according to me, that's been addressed by the discussion we've just had, wherein it's been asked that if, let's say, there is a covenant that is due in the next 12 months, so the question is, if does the management have to estimate the expected ratios for the next year so that it can substantiate whether there is any difficulty in complying? So I think you just mentioned about that, MPB, about the predictive thing, and if you do see some challenges, the disclosures will need to come in. Smriti, yeah, sorry.
That is, Archana, that is precisely the role of the risk management committee, if you really ask me. That they have to actually identify the risk, assess the risk, and try to mitigate the risk. Now, if we are expecting that probably another wave of the COVID would come, it is very natural that you will have to assess as to what is going to be the impact on your financials of all this and how your ratios are going to be impacted. But at the same time, then you will be expecting something more. And there I will like MPV to chip in. That whenever COVID would come in, the RBI would also chip in, saying that we provide relief. The government would say that we provide relief. Now, whether I will be able to predict relief or not, that's $1 million question.
But sir, I think I wouldn't worry. I mean, even to the point that the querist raised, in terms of is it really adding on a new requirement of looking at, bringing in predicting and so on. Wouldn't I have looked at this from a liquidity perspective while doing my going concern assumption? I would anyway. The benefit I see is this information the auditor was anyway taking this into account. Now it becomes available to a user of the financial statement also for their own purpose. So I don't think it will just be something new that needs to be done to say management would not have kind of looked at this. Anyway, loan repayment, ability to kind of defer, etc. for the next 12 months, we would have considered. I know many are waiting for the discussion on carve-out, but I just have one question on this classification bit before we move on. We've discussed so much in terms of the classification requirement, the future covenants, and the fact that disclosures have to be made. I'm going to start with Smriti, sir, and then I'll come to you as well. Because it's easier said you make these disclosures, and I'm just raising a question. Management tends to be typically very optimistic. They will say, listen, everything is fine. We will be able to meet. You ask them, they will give you some basis on, on how the compliance will be done. How do you really see this panning out in terms of compliance in spirit, wherein, in terms of transparency, really bringing out where the challenges are, or do we run the risk of an over-optimistic management and, disclosures not coming in? And that's my question to Smriti, sir. And the same question to you more from a governance perspective, since you're on the board of some companies. How would you be looking at when we look at these disclosures from a board perspective? So Smriti, I'll start with you first.
Yeah, so Archana, 2-3 points. The first one is that as the standard will now require management to look into next 12 months and confirm whether the company is going to comply with those covenants or not. So first of all, from a standard setter perspective, we have to then look into it. The management has to put in the numbers in place and say that whether I'm going to comply with or not. And as you said just a few minutes back, that this also goes back to the going concern testing, which the company will be doing, which the auditors are also going to look into to say that, okay, what is the liquidity position of the company? So in a way, these whatever management is saying or management is over optimistic or whatever, it will also go through an audit lens. So that's the way I will say. From a company perspective, the way I look into it is now we know that, okay, this is an important disclosure that we have to make it in the financial statements. We have to be early in the game. We have to look into our covenants in a way on a fortnightly, monthly basis to say that, okay, are we complying or not? If there are certain risk or we know that, okay, we may breach certain of the things, an early discussion with the lender will help so that then the company is able to mitigate the risk if they are getting into. But and also just looking in from that perspective, it is not only about that particular loan that we are talking about. Nowadays, it is very common that there are cross default clauses as well. So from a company's perspective also, if they breach a covenant in one particular loan, if it has cross default clauses, it has a big risk in terms of its own liquidity position. So from a company's perspective, it will be very clear that they're just looking into that more rigorous rather than being very extra optimistic around it.
Sir?
Very frankly, I thought that you will raise this question to MPV, who sits on a much bigger companies than me, basically on the
I'll come
boards.
to him as well. I'll come to him as
Yeah.
well.
To me, whether you retain carve out or you don't retain carve out, I'm being very frank today. It doesn't make too much of difference. I was in favor of the carve out all through. I still remember when Sir David Tweddy used to come and would say that India should actually not converge, it should adopt IFRS. I was the one who always said that we are a sovereign nation and we have our own problems, and we do appreciate those. We cannot put our industry to some kind of a disadvantage. So we should have the convergence rather than the adoption. That's besides the point. But I think MPV knows that when we were discussing it even in Nakas, and probably you also know it, I was very clear on one point, and I think the entire Nakas was clear on that particular point, that the kind of covenants that we have today, there is nothing like material or immaterial. Let's be very clear so far as or important or unimportant covenants. The banker does not say this is unimportant, this is important. Though to my mind, what is the most important is the repayment of the interest and the principal. If someone asks me, what is going to be the most important part? The ability to repay the debt in time, very frankly. Now, if you have delayed some financial statements, or if you have delayed stock statements, you have delayed filing the guarantor's returns or the net worth, to me, that's not that important, probably. But are the bankers willing to dilute their right in such cases for recalling of the loan? The answer is no. So, what is going to happen? And mark my words today, you go to the best of the enterprises. I'm not talking, somebody should not feel offended. I'm not talking of certain 2 or 3, 4 groups. But most of the groups, even which are bigger ones, they default either on this or that, as on 31st of March. So should this non-current become current on their balance sheets? I think that is the point that we have to be very clear about. Should we distort the ratios of these companies? That is the point which we have to consider because we must appreciate, we must try to assess what is the magnitude of this problem in our country. And if for the last 6 years, the industry has not opposed it, very frankly. Industry, it may be sportive of the industry, whatever you may say. And the bankers have not felt bad so far as this particular part is concerned. Bankers have never come and told us that you must classify it as a current liability rather than non-current. Why this carve out has been given? It has not happened. One way of looking at it is that we want to be absolutely word by word what the IASB says or IFRS says. The other thing is, if it does not affect materially, so far as the ultimate outcome is concerned, and as I said, again I repeat that at the cost of repetition, the same bankers have not recalled any of such loans in any of these circumstances. The banks have been able to recall the loans have recalled loans when they have noted a fraud, or when they have actually seen that the borrower does not have the repaying capacity. In those circumstances, I have never seen a banker recalling a loan for the purpose of non-filing of stock statements. I have not seen them actually doing it for the purpose of non-filing of the guarantor's returns, but they reserve the right to do that, basically. Now, I think that is a challenge to me. The management will continue to say this. You do whatever you want to say. Whether the Smriti said that now since it will become a part of the standard and we'll be able to argue it out before the board that it has become a part of the standard, so we have to do it. Board members, I can tell you, are going to argue against you if you are a chartered accountant as an audit committee chairman or a member of the audit committee. That how does it matter? Has the banker taken any action against us all these years? So why do you want it to be shown as current and distort the current ratio for that particular matter? That is the biggest challenge to me. I am not against removing the carve out. Let me be very clear about it when I sit over here and I argue it out. To me, the biggest challenge will be how the ratios of these companies would be reflected in the financial statements and what impact it can make internationally also on their financial statements. I think that is the point I'm trying to make out. You are on mute. Archana, you are on mute.
Sorry. I think when Smriti mentioned, I think she was disclosures, I think she was referring more to compliance with the future covenants and the ability from that. But since we moved on to the carve out, I think this is a very important area. I will also request the chairman, first of all, to come and give an overview in terms of the thinking from a standard setter perspective. But just before that, I think the way I see is I do see a mixed, mixed views here, in the sense there is a group which does feel that if, like you just said, if the carve out, if the condemnation of the breach has happened, right, it could be material or immaterial, but and it's been working well, like you just said. If that has happened, if you know money is not going to go back, it's not going to be repayable, why not continue with it as non-current rather than necessarily converging with IFRS? The counter is that if you've got a conceptual definition, you kind of comply with it irrespective of the outcome. So while you've got something non-current, let's say a breach would have happened later, you would have not moved it to current, right? So you would have still applied the definition. And therefore, the way I see arguments on both sides, one is to say you go by the conceptual definition of what is a liability. Fact remains on the reporting date, it becomes repayable. The other, like you just said, is about substance. This has actually been condoned and not repayable and take. So I would request the chairman, first of all, to just share. Yeah.
Just for a moment. See, if the account has been restructured, the banker will never tell you that I condone your non-filing of the stocks. Let's be very clear about it. I have not seen it happening over a period of last 40 years anywhere. They will not say it under any circumstances. What is going to happen is the restructuring of the loan or non-restructuring of the loan. If it is a restructuring of the loan, everything stands condoned. If it is not, nothing stands condoned. The point that one is trying to make out is this all about the substance part, and how do we look at the action of the same lender earlier? That is my precise point. But again, I repeat, at the cost of a repetition, I don't mind the change happening. Let's be very clear about it.
So, sir, I mean, before I move on to the chairman, since you've already spoken so much about it, one question to you. And I'm just saying while we will have a background from the chairman in terms of the thinking that went into removing the carve out, but there is also this argument that the fact that a company did default, fact remains it did default, as at the balance sheet date, the breach was there. They may have got it condoned later. Shouldn't it come to the knowledge of the reader that yes, something, it could be minor, like you just said, and nothing, the bank will do nothing, but it could as well be a major covenant, etc., which was breached. From a governance perspective, do you feel there is any merit? I'm just asking.
I think a very important question that you have raised, and a very interesting question at the same time. Having sat on some of the audit committees also, I've not found the covenants being discussed one by one whether you have breached any of the covenants. We do get a certificate from the company secretary, or either inside or outside, that whether you have complied with the all laws and regulations, basically. But whether all the terms and conditions, he will write all the substantial part, even if you ask for it. So he will never mention that any stock statement was not submitted in time, or financial statements were not submitted in time, guarantor statement was not submitted in time, or certain other things didn't happen in time. My point is very clear on this. Even if you are on 31st March, they have not filed certain things. The banker in writing will never give you that it is condoned, but he would not have it recalled the loan. Now, can you treat it as substantive or not? To me, you can treat it as substantive then. If till the approval of the accounts, nothing has been recalled, then what can be more substantive than this? It is implied condonation. Why it should not be treated as an implied condonation? No banker is going to tell you that this is my major covenant, this is my non-major covenant. They are not going to tell you that.
So
They will say these are the covenants.
no, I get that, sir. So my question to you is that let's say forget implied. I'm saying there is actual waiver, actual written. Let's say for argument's
If it
sake.
is that
No,
actual
no.
condonation by way of a letter, then it's fine.
Yes. So
There
my
is no
question
problem.
is, my
And
question is,
disclose
let's
it.
say, that is my point. That is my
And
point
then
that you
disclose
had
it.
a company
Fine.
which
I
breached.
absolutely
Okay,
no issue.
that was the point I was getting at. Okay, maybe I'll let
No.
the chair come in from a standard setup perspective. Share
So,
the thinking.
Archana,
It's a very
I
important.
would just like to add in few pointers here. So, say from a covenant perspective, also there are certain covenants like filing of stock statement or filing of certain other disclosures, etc. These are the easy ones to fix, or in a way, generally the lenders will not come and say that okay, you now repay my loan because you have not abided by the statement filing or something like that. But at the same time, there are certain other ratios which the company has to comply with. And sometimes there is also a whammy from a company perspective that some of these ratios are calculated as on the reporting date. So if say company is filing or preparing the financials for 31st March 2023, they will know once the balance sheet is done in a way to know that okay, whether the covenant is complied or not. And in such situations will become a very, very tricky situation for a company because it will have no time to get the condonation in a way by the time they approve the financial statements also. So we have to just look in it from that perspective as well.
Absolutely, well said.
Right, I'll come back to it, but maybe I think first I'd like to just hear from let him set the context and then maybe we can deliberate. So I will request the chairman just to kind of discuss the thinking behind it and why this, from a standard setup perspective, why this removal can be very important. Removal or retaining.
The discussion is really very, very interesting and very warm, I would say. And what is the purpose also of this outreach program is also same, to have a very transparent and open discussion. You know, government, MCA, and others regulators have been time again saying that we have to be fully conversant with the IFRS, and we at that time when we implemented, when we converged to Ind AS, we had seeing the Indian conditions. We said, okay, we are not yet ready. Let us have certain carve outs into that. We then slowly removed few carve out, but still there are few carve outs left. Now this one India's one was being amended. Again, we had a discussion first internally and then in the ASB also. And we had certain discussions earlier when we were having such a certain quarterly meetings with the RBI also. So they also want that yes, these carve outs should be as far as possible removed. But if we talk about the basic purpose was to keep it more convergent with the IFRS, and secondly, of course, to have that what we say financial discipline. Now, if I talk about not what you have been talking about ASB chairperson, I'm talking as Pramod Jain, not ASB chairperson, as a member of the institute. So when I talk about as a member of the institute, you just tell me. One, there is an industry. Second, there is a banker. Banker says, I don't want to lose my rights. Smallest loss of convenience. You say, I can recall the loan. Industry say that, okay, with this conditions, I'm ready to take the loan. I'm ready to take the loan. If the industry is having that clarity, if they are having that financial discipline, where the industry says, okay, I will not allow you to have that power. They are not doing it. They may not do it. They would not do it. But I don't want you to give the power for small breaches like non-submission of the documents or getting certain stock statement letters and all those things. So while having that sanction, the borrower and the banker, they should agree, okay, for this we'll have the financial liability. penalties, and for this week we'll have the power. So it is amongst them. So if legally they are saying on a breach of a small covenants, we have the right to withdraw the borrowings. Then as per the law, though, if we say definition of current and non-current, they say we are having the power, we are not using it, but agar, if someone says, then I can again anytime use it. So why don't they two come together? Why don't they do? This is my personal thought. You know, if the banker says no, I don't want, I want to have the right, and industry is ready to take that covenant and still take the loan, then as regulators, ICI being a regulator and seeing that okay, you are saying something different, having something different. So all that thought process again, the industry people are here, the bankers are here, the regulators, RBI are there. So they all have to think, and they feel they can share their points out there. This is my initial thought, President Sir and MP Sir and Smriti and Arjuna ji.
So, sir, do you want to
No.
first? Yeah.
No, very well said by chairman. Of course, he says that he's the member of the institute only, but to us, he is definitely the chairman, who succeeded none else but MP for that matter. The most illustrious ASB chairman, if you really ask me.
Yes.
Thank you, sir. Thank you.
Now, the point that I'm trying to make out, Archana, is that I think Pramod ji said very, very rightly, the chairman said very rightly, that industry, bankers and the regulators must come together and say as to what do they want to do. They don't want to come together. But Pramod ji, the problem is when you give a house on rent, at that time the tenant is not willing to read the tenancy deed. He says, come what me, you say that I can come in every month and inspect the house. You will say, okay, come, I will tell you whether you come or you don't come, or I will permit or I will not permit. Similar is the situation here. We all are treating stock statement as a very, very flimsy ground for a recalling. To me, stock statement is probably the most important, or non-filing of the financial statement is the most important ground for recalling of the loan. Where the maximum frauds have occurred, either the stock statements have been overstated, understated, or not filed at all, very frankly. And the RBI says that if you have not filed the stock statements for a period of 180 days, the account will be classified as a non-performing account. The beauty is that the Reserve Bank of India itself says that if there are temporary deficiencies, I'm raising a very pertinent point now. In their master circular, they say that if there is a temporary deficiency as on 31st March in an account, now that temporary deficiency can be with regard to the current ratio, it can be with regard to the non-filing of the stock statement, it can be with regard to anything. Then they say, or the limit is overdrawn. Then they say, you may ignore it. It may not be treated as NPA. Why can't they come here together and say what is temporary, what is immaterial, what is non-major, and where the account could still be treated as non-current rather than current? That's the point I'm trying to raise. Yeah.
Sir, one very small point. If I talk about submission of stock statement debtors, they are normally for my CC limits, OD limits. They are always current. They are always current. The only issue would be for a long-term loan, where it could be termed as a current for the breach of the covenants. But for the CC limit is whether there is a breach, it says or not, they can. It is always a current. Only for the long-term loans for machinery. So there the covenants they can draft now.
The beauty is, Pramod ji, let me get away from the stock statements. They always lay down that subordinated debt cannot be repaid till the duration of the loan. And and their bank managers pass those checks, basically, where the subordinated debts are being repaid. And there are so many other things, basically. They say that you cannot have transactions with your subsidiary or with your associates or with your joint ventures. But who doesn't allow? The bankers allow themselves. No, what? Because there is not one covenant. No? There are many covenants, basically. When they provide you the bills facility, they say that these are not to be the accommodation bills, these are to be genuine trade bills. But the bank manager can find out whether it is accommodation bill or genuine trade bill. But I'm not getting into their fault or their default. What I'm trying to say is that all these covenants, no, I don't think the audit committee can sit on this. Let's be very clear about it. Whatever anybody may say, none of the committees of the board will be able to find out what kind of covenants have been defaulted. Now, looking at that precarious situation, how do we resolve that issue? That is the point. I am fully with the institute on this point, very frankly. I adopt it where is the problem? But tomorrow, the same industry, the industry which may not be reacting today for this removal of the cargo, tomorrow they will be again with us that we are be facing all this kind of a hardship. So whatever we do, I think we may require more meetings with the industry, apprise them that this is what is going to be happening. So don't come tomorrow to us, and we can tell the regulators also that tomorrow you should not say that the loan cannot be granted to a particular person because his current ratio is distorted now, basically because of something which shown as current. All these bankers and all these industry wallahs must understand what is the consequence or what is the implication of the removal of this cargo. That's the precise point that I would like to make.
Very, very rightly said, President sir. MBB sir would be chipping in, but very, very rightly, sir. That's why this outreach program we are having more than nearly 2,000 participants from the industry, from the bankers. So what President sir is saying, if you have an issue, discuss, and then you still have time within this month to present your views. MPV sir wants to chip in.
So thank you, Pramodji. Actually, it was a treat to listen last 15-20 minutes non-stop on all the discussion which was going on. In fact, Chairman, if it's convenient with you, and I was briefly mentioning this to Parminder partly. See, the implications for industry, I'm not sure whether the industry has understood it fully. It is good to go in this direction. There's no second thought about it. I think we're very, very clear on that. But it's important that industry should not feel that there's a fait accompli on us. We have been not been adequately sensitized. My request is, if time is available to you, you could do one session through SEBI for the listed companies, because the industry participation will be little more serious when you do it with SEBI. That's the request I have. Second is, you can do one event with the banks and the rating agencies. So we have another 20 days. I know there's a change of team, but you can still manage it. So before February 28th, if you can manage these two, it will be very, very effective. In fact, as far as carve-outs are concerned, I think as an institute, we have always held the view that institute and the country will reserve the right to do what is best for the nation, considering its economic development status. And also there can be instances where conceptually we may have a strong difference with IASB as well. We might have a very strong difference. So I think the fact that we would like to carve outs or retain the right to carve outs, I think that is undisputed. We'll always have that. On India's this specific carve out, I think it was essential, and full kudos to the leadership at that time. Had this carve out not been there, India Incorporated would not have emotionally aligned to the decision of moving to Indies. There would have been more resistance. The entire thing would have got pushed by another 3-4 years. I think these carve-outs have helped the India Incorporated to get the confidence that, okay, there's something in it for us, let's do it. And if you look at the carve-outs, there are reasonably good number of carve-outs, particularly the optional carve-outs in 101. Many companies have not adopted. I know a few Tata Group companies itself who have not adopted those carve-outs which are available in, or options which are available in 101. I think India Inc., it was more emotional support which was given. Having said all this, I think it's 8 years now since the standards have been rolled out. And I would like to, Pramod Bhai, maybe get a little personal. In fact, I've seen you in the council last 3 years. And between then and now, I've seen a huge transformation in your outlook, actually. In fact, I was mentioning to a few people that when you occupy a chair or a responsibility of regulator, your thinking changes. You start feeling more responsible than ever. Sometimes you tend to be, you think you are pro industry, pro whatever, but you are actually harming their cause. But once you occupy the chair, you start thinking what is good in the long term for the industry. You don't look at what is good in the short term. And I'm seeing the transformation in you, phenomenal transformation, and I just want to give you credit for that. And honestly, I want to tell you, this particular amendment which you have proposed now, I don't think I would have been able to take with the same depth. I think kudos to the composition of the board and the officers as well, and importantly, leadership, that you decided to put it out in the public domain, that it's now 8 years. And friends, it's time we evaluate whether we still require the carve-out. I think you deserve that special credit, Pramod, and I'm extremely happy about this thing. We may eventually retain the carve-out or have a modified way. That's a different issue. But I think the ability to come out in the open and say that, friends, it's time to relook. I think that's a very complimentable one. So credit to you. I would just like to place a few facts regarding the carve-out. I think we are fifth largest GDP in the world. We will be a third largest GDP anytime soon. And as a capital market also, in terms of market capitalization, India is the fifth in the world. And the capital market also will soon become third or so at some point in time. And there is enough and more indicators around lots of overseas capital coming into India and Indian enterprises going out, Indian enterprise going out. And if you can look at the last 10 years, look at the number of Indian companies who have set up shops outside. It's so enviable. So Indian multinationals have all come up. I said at the start that Ind AS is actually for listed companies. And for listed companies, my view, there is no justification for an exception on a conceptual item like this for listed companies. I don't think we should ever have that. And if listed companies where there is public interest, investor interest, I think the global best practices need to be followed. And I think you made a good explanation that this problem is largely for non-current loans. Non-current liabilities, typically the problems we have is security creation. In India, our biggest problem is security creation. As a company, I want to create security, but unfortunately the ecosystem, the approvals, etc. don't come in place. I'm not able to create the security. That is why the bank has the right to call back. The second issue we have is banks normally sanction a term loan and the project starts, they tell by the time you achieve 20-30% of your project, ensure that all the approvals are in place. They just want to allow the project to go. So it's not like the environment approval is there on day one. Pollution certificate approval is day one. So these approvals actually you are supposed to get it in 4, 5, 6 months as the project goes. But unfortunately, there's an election in the state, there's a government reshuffle. So 2-3 months it gets stuck. It gets stuck there. I want to do it. Bank also knows these guys are genuinely putting effort, but the ecosystem is not improving there. Ecosystem is not. But I think what is important is the lenders collectively should understand that even if I show it as current, I remove the carve-out. If I show it as current, they should still give me the benefit of treating it similar to non-current for the purpose of the ratio classification for the bank credit evaluation. Because today, any case they're asking that. For example, today in our own company, I go through this. They know that these are term loans where my conditions are still to be fulfilled. I show as non-current, but they take that input of non-compliance in evaluating the credit. I think if that maturity is coming, and they are supporting India Incorporated. I think India Incorporated will be indifferent in terms of showing it as current. Why are we hesitating towards showing as current? It's only because current ratios will look odd. The fund flow of long term to short term will look odd. So it is those problems which we have. So it is, if those problems, if the ecosystem can support, I think we all can go there. So my request is to have the engagement with IBA, and through the IBA to the banking system, rating agencies and SEBI listed companies, so that all of them are also on board. As an institute, we want to do it and we should do it. And my view for listed companies on this, there should be no compromise. I repeatedly come back to the point that the unlisted 250 crore net worth small companies who have to grow, for them it is onerous, because as a large company, I can still tell the bank that, look, I want this condonation letter by 28th March. If you are not giving, next year you are out. I can still tell it. But a 250 crore net worth, he will not have that power. That power he will not have. So he suffers. So those aspects we have to consider. But having said all this, I think we can make one big jump, remove the carve out fully, or do it in two phases. Phase one, add a disclosure of the term loans where there is a default, and give the explanation. And let us understand on default also. Today, actually, the carve out is not really beneficial. It looks like beneficial, but it's actually not beneficial, because 31st March, most of the listed companies we race to complete the audited accounts by Tata Group does it by 9th April, 12th April, 15th April, 25th April. So in those 3-4 weeks, if you have not got the condonation by 28th March, by 28th April is not too much of a time. It is for those unlisted companies, you actually get time up to June or whatever. And most cases, the banks, at committee level, we don't get approval. We actually get letter at the branch level. He says that it is under active consideration. He'll give some language, You actually encourage certain practices which are not good. I think if you can take the other stakeholders also, it will be good. And I want to compliment you once again for putting out in the public domain this discussion. And we are all with you if you want to make that one big jump, with you. Or if you want to do it in two phases. Phase one, add disclosures. After 3-4 years, move to the next one, with you.
Just
like
thank you,
to
MP,
add,
sir.
so Pramodji, I would
Like
just
just
like to add one more point here on the carve out. Just also think it from that perspective that many of the Indian entities has now very large subsidiaries outside India, and they have been following IFRS. So think from that perspective also that for India we are saying yes, there is a carve out. The subsidiaries outside India doesn't have it. When it comes to consolidation, we do an adjustment again on the classification. So think from that perspective also, from an industry perspective, that if they have large subsidiaries outside India, it makes sense that we align.
No, very rightly said, Smriti. Just to share one or two views from the participants. For example, a few bankers. Ashish ji from ICICI Bank Delhi. He says that post removal of prevailing carve out, covenant default will lead to classification of the term liability as current liability for the loans of which the covenant breach has taken place. To assist lenders for classification for internal appraisal process, can we introduce an additional disclosure of approved condonation of such defaults by the lenders which have taken place before finalization of the annual report, which will help the lenders to internally reclassify the liability as non-current irrespective of classification out of the financial. This is what MPV sir was also saying. Another comment from HDFC Bank, Krishan Mohan ji, Senior Vice President. Condonation will need to be done in advance, effectively revise the covenant prior to the finalization of the accounts. So few bankers. There are other comments also, but I just thought it that few bankers have commented, so just I can put that. President sir, you wanted to?
No, very
Sir, if I can, sir. Okay.
No, President sir wanted.
Archana, go ahead.
No, sir, I know we've been just having this extended discussion. For the ease of everyone, I just wanted to put in two proposition and then because I'm just looking at the time also, and then somewhere kind of see where we are heading, and basis what I heard from everyone. So I feel there are two extreme views. One is that you retain the carve out, and the other is you remove the carve out. Okay, both I feel are an extreme position, and there are arguments for both. So the way I've heard, and just for the summary for everyone, I think MPV refer to the fact that while we may classify this as current, but for the purpose of decision making by banks, they should take it as non-current. I personally feel your financial statement should reflect how the information which the user is supposed, how the user is supposed to interpret it. So if I'm going to put something else in the financial statements, but I expect the user to treat it as something else, I think would that inconsistency really be appropriate? I'll come to you, MPV. So one was that therefore, if let's say, if the main users we are saying are the lenders and they're going to treat it as non-current, then shouldn't the balance sheet also reflect it as current? I think there just has to be consistency in terms of how it is being used and how it is. Okay, you.
Archana, for banks, it is evaluation of credit risk, and as you know, for financial statements, financial reporting, and standards, primary users are the investors. Lenders, they actually rely on something which is more specific information for them and not the general purpose financial statements. So if you look at the framework for preparation of, or the conceptual framework, it refers only to investors. So we're all focused only on the investor community. For
Primary
lenders,
users. It refers to primary users.
users. So as far as lenders are concerned, they always have specific information, specific formats and all. That's one point. I'll give you another example. There are many situations where promoters give loans and tell that as long as the bank loan is there, we will not withdraw that money. So banks, for the purpose of the credit evaluation, they treat it as similar to equity, So those are all on-ground considerations, considerations.
I'm just summarizing. I'm just saying, even if I look at some of the comments which have come, for example, MPV, they're saying, I think, and they echo what is being discussed, is that if we feel that these are minor, and we'll come to what is minor, major, and the bank will actually not recall, why do the banks still keep these kind of rights in their? Yeah. So I think it's a very fair ask that if we have to kind of move towards convergence, then shouldn't there be a reconsideration of what the loan covenants are? On one side, the banks are refusing to kind of say, while in practice we will not recall, but we will retain that right in the loan. And I think that kind of creates that tussle in terms of what is the substance and how does the conceptual definition apply. The point I was just making is, from what I heard, there are two extremes in terms of retaining or removing. The bit which I wanted to understand was, in terms of your experience, if we were to look at situations wherein, let's say, waivers were given and the loan was classified as non-current, did we see any challenge going forward? The company got the waiver, class loan 1 year down the line, liquidity issues, and maybe it would have been appropriate. So I'm going back from a governance or a substance perspective. How do we balance these situations? I'm not saying necessarily that means you do current classification, but I think that is also a factor which comes into it. Today, you are so-called showing it as healthy, whereas it may not be. Actually, there is a problem. It has just managed this financial reporting by virtue of getting that waiver. And therefore, can there be a midway, which I think you alluded to, MPV? Instead of looking at the extreme, can there be a midway that while we, like you just said, do non-current, but the fact that the company did not comply, the fact that this non-compliance and this breach or the subsequent covenant waiver, condonation, whatever you want to call it, in a way, it's a red alert. It just does bring in a risk to attach to that company. Should that be supplemented with a disclosure? So if we do retain the carve-out, my question therefore to the panel is, if we were to retain it, would it be as is or would it be together with the disclosure? So, okay. So I think I can get it from what you're saying. The choice will be either removal or retaining with disclosure. At least that much we all agree. Okay.
We should progress. We should progress.
Yeah.
We should not be at current state. Current state is not good. We should progress.
So the reason I mentioned it, MPB, because you said more about deliberation, and if the industry is going to give in their comments, I think they should not look at the choice between removal and retaining. They should look at the choice between removal and retaining with additional disclosures, because there are a waiver depending upon the nature of waiver, right? When I say nature of waiver, the nature of breach, sorry. It could be reflective of a liquidity issue. and therefore it is something temporary that they've managed, that bump they've managed to get away with, but there could be a challenge. And like Sir alluded again, I think what is major, minor, I don't know, material, material, because stock statement, as he referred, it is directly related to my DP, etc. Would I really say delay in filing if the actual filing shows a very reduced kind of a stock limit? Would that be a material? So I think that also has its own considerations. Sir, would you want to add anything?
No, but I will only like to say, you see, so far as these non-current liabilities even otherwise are concerned, take the case of a term loan. No, a banker would ever lay down a covenant that you have to progress this much by a particular time, and you don't progress to that particular level. Now that's also a breach of covenant. Now, unless the bank actually approves that, how do I treat it as basically? Now, the problem I can tell you it will, if we actually start disclosing all this even, forget about removal of the carve out. The bankers will have to also have to act in time. That's also going to improve their working. I'm very clear on that. Because what is happening today, you send a proposal to the bank that this is my position, it will be buried under, or it will get into the bureaucratic approach. It starts from the branch to the zonal to the head office and head office to back, henceforth. I think this will be something good, because if they know that because of them, the classification is getting changed somewhere, so they have also to be very, very careful about it. So my feeling is that we should go ahead at least with some change. And you are talking of disclosure. Let's go ahead with the disclosure. But before even getting into that change, my request to the chairman and the entire team would be, as I said earlier, and I think MPV recommended it very appropriately, through SEBI, we call a particular meeting of the various players of the industry, of the listed entities, and through the other regulators, particularly the Reserve Bank of India, we can call the meeting of the various bankers on this particular issue and the RBI. Probably let's apprise them as to how serious the institute is on this. That the economy does not suffer, the India incorporated does not suffer. That's very, very important. And I think that will reflect institute in a very, very positive manner. So, to my mind, it will be a very, very good step if we say that yes, we take a decision with regard to the disclosure, but even that is to be actually with the consent of the industry and with the consent of the other regulators. That's the way I look at it. And I think the point which is raised by MPV with regard to, as I talked of the subordinated debt, because whenever the promoters gives the loan, and says that he will not withdraw it during the currency of the loan given by the bank, this is treated as a subordinated debt and equivalent to equity, basically. Now, but this keeps on getting repaid, very frankly, I can tell you, and very, many of the organizations. All these things we must bring out. Where are the covenants being breached and what can be the implications thereof? Let's tell it to the industry, let's tell it to the regulators, and then try to find out a solution. But to me, the best solution today would be, as you also proposed and MPV also said, and I think Pramod deserves the kudos for it, that we should go ahead with the disclosure part, at least, to begin with. And then after another 4 or 5 years, based upon the experience, at least I will not like to say that Pramod would continue as ASB chairman for 3 years, because he has to be promoted somewhere else also. So I will not like to hazard that guess. So, but the point that I'm trying to make out here is that we should go ahead with this.
Yeah, and I think it's a fair point, and maybe I'll go to the other panelists as well. And before I give my comments, MPV, do you want to add to it?
Yeah, Archana, I just want to add on another point which you mentioned, and I want to set the expectations of all the participants. The banks will not dilute any of their rights, however small it might be, they will only add, because from a lender's perspective, it is risk money. So in case they see a risk, they would like to use the smallest excuse possible to recall the loan. I have lived those situations. And from bankers' point of view, they will not forego that. So I think it's important that there's a collective work happening in terms of how the banks can respond faster to tell that yes, we are able to condone, not condone. I think banks also have to walk this, because banks have to realize one thing, that we now doing all this in their interest. Who is the biggest beneficiary in the process? It is actually the banks, and the person who is suffering because of the carve out is the banks. So if there is someone who can actually who actually will benefit the most is the banks. I think we should ask the banks to walk that step and tell that any condonation will work fast and give it before the balance sheet date. We'll be proactive in terms of credit for the India's companies. How many companies here? 10,000 companies. The bankers should be able to do it.
And Chairman, if I may just take the liberty of making a request, is when we are doing these outreach with SEBI, banks, etc., I think one more is, like I mentioned earlier, somewhere we need to kind of see the past trend as to what really happened in situations where waiver is given before we decide which way to go, to see whether these are really just temporary blips, which have some merit in terms of, still continuing being classified as non-current, or do these really represent a significant red alert because of which may be a current. So I think I'm just saying from that perspective also, if some kind of if any trend, etc., or any past experience is available, that may also just help. Smriti, any comments from you from an industry perspective on this?
Archana, you'll have the IBC case itself. Take some 20 IBC cases. If you look at those cases, they would have had those red flags. See, what happens is they would not have collapsed within the 12 months. But a company which has this kind of a deviation for 2 years, 3 years successively, most likely would collapse. Or at least those who have collapsed would have this. I wouldn't say that the successful one, but those who have collapsed would definitely have this as an indicator.
But even if a minimum, let's say, disclosures are added, hopefully the readers will get that information. Right now, they don't even get to know. It gets condoned, nothing comes to their attention. At least the fact that there is a red alert would come. Okay.
Exactly.
Smriti,
And
anything from your side?
Auditors will do an EOM if it is very material. They may do it. It might help from that perspective as well.
So two things here, Archana. So first thing in it is that if we go the IAS one way, where we say that, okay, we put it as current only and don't get into that whether we need to put in a disclosure. Obviously, on the face of the balance sheet itself, it will be shown as current, and it will be a red alert to the readers to say that, okay, there is a breach of a covenant, and because of that, the company is showing something as current. In the standard, the amendment which is proposed itself says that, okay, we have to also give that fact in the disclosure that whether we have got the approval before the financial statements has been approved or not. And that fact can bring it out. So the users will be able to understand that, yes, there was a breach, but it has been condoned by the approval of the financial statement. That is one piece of it. Secondly, if you're looking into that, okay, we just give the disclosures, that also gives an adequate, in a way, red alert to an user to say that, okay, there was a problem in this company, there has been a breach which has happened. So either way, the users will be able to understand the risk which is there in the company. So it can be both ways. As MPB said, that we can go step by step. One is just give disclosures first, and maybe after 2-3 years, getting into the IAS one way.
Chairman, anything, or maybe can we move on to the next issue?
Yeah, please.
Okay. I think anyway, looking at the time, just two other things, if anyone, I'll leave it open to the panelists to kind of share. I think transitional provisions are straightforward. I don't see any significant issue in terms of interpretation there. I think MPB has.
Transitional, my view, Archana, is that if you look at most of the transitional provisions in the recent past, which are nature of amendments, so we have had a modified prospective approach, where we actually do it only in the current period and not the previous period. And my view is, in this case, I think if you go and tell the previous year also you do a reclassification, suppose we move to the other direction or a disclosure in past period, I think we'll be putting people in very bad light. I think it's a journey. I think we should do it only prospectively from this period, even though it impacts comparability. I would suggest that.
I'm not. Then MPB, if it's okay with you, maybe when the office does finalize, I would say one is to look at the impact in terms of the amendments, how many of these are really clarificatory and how many of these will really lead to big big item changes, and it would also depend upon whether the carve out is retained or not. So depending on that, maybe a decision can be taken. And my understanding is typically retrospective versus modified retrospective also kind of balances between comparability and the cost benefit approach. Here, comparability would be enhanced by retrospective. I don't see a challenge from a cost benefit in the sense, I don't think the effort would be so. So from that perspective, there are conceptual merits in terms of retrospective, the way at least I could see. But maybe depending upon the final outreach comments that we get, the office can consider that. I also wanted to take your input, MPV, and maybe even Smriti, from an industry perspective. This convertible debt, when settlement is happening through your own shares, right? Do you see that as just clarificatory, or do you feel that you may see companies changing their classification because of that? Or do you think that's largely clarificatory?
So in the convertible debt, in the initial thing, when Archana, you have explained it, so there can be two types of convertible debt. When it is fixed to fixed, obviously the company is showing that as equity, and there is no classification challenge. This classification challenge will come in when it is fixed to variable, where the company shows that as a liability. Now, if we go to the definition in terms of the proposed amendment, it says whether the company has right to defer. Now here, the company may not have the right. It's the lender who will decide when they want to convert. And from that perspective, I will say I don't think so that the current standard in the proposed amendment is going to change the classification. From a company perspective, if it doesn't have the right, then you will be still showing this as a current right.
In any case, Archana, this right will be exercised only in the case you are defaulting in payment. This right will not be exercised otherwise, very frankly. If the company is running well, then there is no question of exercise of this right.
No, sir, there are certain debts where there are if you meet certain criteria, or say like your revenue is so much or your profit is so much, then the lender can get into exercising its option to convert it debt into equity.
So let me take an example. Let's say you've got a bond, which per se would be, which will, let's say in the due course get redeemed maybe after 3 years, 4 years, whatever. But there is a conversion option. And like Smriti said, that conversion option is classified as a liability. And let's say that the bond also gives the option to the holder to convert. This conversion option can be exercised any time. So the question is that on one side, your redemption may happen later, but the conversion can happen any time, which means it can happen before 12 months. And that is where you would do current. But where the standard is saying is, okay, but if this conversion option is equity, then this would not impact your current, non-current. So I don't know whether I'm able to explain my point. So if the conversion option is liability, many companies so far were ignoring the conversion option and looking at current, non-current without looking at the conversion option classification, if my understanding is correct. So I was just wondering whether that's really mixed, or in terms of the industry practice, or is it in a very limited case? But I think I see this more clarificatory in nature, and I do not know whether a significant change is expected. So I was just curious. Okay. Any final? I'll go to all the panelists one by one, and maybe just final closing comments. Any 30 seconds comments? I'll start with Smriti.
I will say that this is a welcome proposed change. We get more aligned with IS1, and in a way, especially for the listed companies, the financial statements are comparable with what other global peers are doing who are preparing financials under IFRS. So that way, it's a welcome change. Some of the things which, from an industry perspective, the companies has to really look into it, in terms of monitoring these covenants very closely, so that they know upfront if there are any problems, go for waivers before the reporting date, so that then there is no problems per se in terms of classifying that as current and getting into all those disclosures, etc. So that's one thing. Second is the standard is also asking to give in the disclosure of what will happen in next 12 months. Again, it's a welcome change in terms of a reader will be able to understand the risk if the company is having anything. So from that perspective, I believe that the amendments which is being proposed is a good one from an overall industry perspective, from the transparency perspective of a financial statements.
Thanks. MPV?
Same, Archana. Nothing to add. I think Smriti said it so nicely.
I have also nothing to add. I have nothing to add. except for the fact that I would definitely recommend the mid approach, basically. It is the midway path. First go in for what MPV said for the disclosures, and then we go for the removal of the carve out. I think that's the way I will like to look at it, but I will not mind even if the carve out is done away with. But whatever is to be done, I am very clear on one point. Whatever is to be done, it should be in consultation with and after apprising the industry and the regulators and the bankers. That's my only precise point.
I must thank all of you before I hand over to the chair. I think very interesting and very insightful.
Archana ji, very, very interesting discussions. Yes, of course, we have sent this exposure draft and this today's outreach program to all the leading industries. I would say, FIC, CI, we have sent to everyone. Many of them have joined also. What I could make out that yes, if we are, we have already proposed, the institute has proposed for the removal of the carve out, and what the points which has come out from the today's discussion, if I take a brief summary thereof, that if this carve out is done away with, because as it would depend upon the industry and the bankers making their response, comments, suggestions on this removal of carve out. I'll again request, whatever are their thought process on that, please spread that. Please spread that to your fellow industry, fellow bankers, and give your comments at comments@asb.ici.in or asb.ici.in. Right. Secondly, if I talk about if this carve out is removed, then from the banker's point of view, of course, if they feel that they can amend this, it is not for their CC limits or OD limits, it is for their term loans, again for the term loans, long term ones. There they can have this different sanction letters in such a way that where the breach of the covenants could be defined in such a way that which will have the power to recall and which will not have. है ना? or happening was certain event which the bankers at their head office level can do, which can go down. Or what was the suggestion of MPV sir also, that though it is this term loan because of breach of the covenants is classified as a current liability, but for their purpose of calculation of their ratios for the lending and other things, they have their own thing, that asking the borrower and then calculating their ratios accordingly, and that purpose. And of course, one of the very right, another thing which was discussed, that the see that there is a breach and the corporates or they apply to the bankers for the condonation, and they give that before the financial statements. So that would help them. From the auditor's point of view, again there would be, I would say, two issues. One is of course that they have to be very careful that if there is a breach of the covenant, then they have to see that the classification of these long-term liabilities loans are done properly. Point number one. Point number two, if there is a breach of the covenant, and in case that it is classified as current, then they have to be very clear about another component which they have to report in Caro, that the happenings between the balance sheet date and the signing date of the audit report, the company would be able to meet the liability which will be there in the next coming 1 year. It is in Caro, it is there, they have to give their opinion based upon the ratios, receivables, and payables. So that amount becomes payable in that year. So basically, it is solvent or not. So auditors also will have to take care. So bankers, industry, auditors, it is all collectively, which I feel. So this is just I wanted to put before everyone.
That is for even AS companies.
Yeah, that is why you AS companies. Yes, sir.
What past president has done through Caro is for AS companies also. But that discipline will improve. No, the discipline will improve, Pramodji. See, my view at leadership level, we should think long term.
Yeah.
Tactical is not. I think that way it's good.
So thanks to the moderator, and thanks to the
Thanks to the-
chair, and of course, thanks MPV. It's a long time after which I have shared anything with you for that matter, and Smriti.
And thank you,
Thanks all.
Thank you so much.
Thank you.
Chairman, do you want to close?
Yeah. Thank you very much, President Sir, for participating, giving your views, and of course, making the session very, very lively. Smriti ji, thank you very much for bringing out the views of the industry, which you represent, of course, one representation, but you have been very positive about it, talking about that no need of further adjustments in relation to this point when we have to prepare a console for the overseas thing. And of course, MPV sir, always my mentor in this, because the way I see he understands the standards and he presents thorough learning for me from him always. Thank you, MPV sir, for giving your views out there. And Anshita, thanks a lot for moderating such star words in such a way that all the participants have been very, very appreciative. And of course, thanks to the whole of our ASB Secretariat led by Parminder ji, SN Gupta ji, everyone out there. And of course, my vice chair is just preoccupied. He just called me right now. Something stuck up. So from his behalf also, I thank each and everyone. And I thank all the participants for making this possible and also sharing your views. We could not take all the questions because of paucity of time. But I'll request again and again, please share this with all the companies who are following Ind AS, with the bankers, because you will be auditing also, the bankers also, that okay, this is proposed, and request them to please send their comments by 28th of February 2023. I request. And thanks to each and everyone for joining. Thank you very much. Thank you.
Thank you. Thank you.